So we're looking inside this range here. Okay, this is our specific dealing range. What do you see? Before I go further, wait a minute, ICT, you just said that's a dealing range. Right. These are relative equal highs. It went above into the fair value gap with this here. And we never were able to go higher. So I'm looking at that as that's the cap on the marketplace. And it's likely going to be a breakaway gap. That means it doesn't fill right away until it fulfills lower level objectives on price down here. So what do you see in here? Pause the video. And when you're ready to continue, unpause it. All right, so we have this high to that low. Why am I picking this high? Because it has the most energetic price run away from it. It's the most recent one that has that energy going lower. The delivery of the candles moving away from it quickly. That's what I'm really getting at. So I'm framing it with the logic that this is likely to stay open, not rebalance, and the market's going to drive lower. So our range from here to here, that's what I'm measuring, and equilibrium is here. So above that level, this level here, what are we looking for? Well, we're looking for buy side. But classic support and resistance idea is this. We've taken out this low, relative equal lows. Okay. This break below it here is shallow and it's short-lived. And then we broke down aggressively through it. So classic support and resistance traders are going to do what? What are they going to be thinking about that low once it broke through it here more meaningfully? They're going to assume that that was support broken, now turn what? Resistance, right? So they would expect price to trade up into that level right here and then trade down from there. Not understanding any of the logic as to why it would do this at all. That's narrative. That's the reason why retail traders suck. Because they just simply look for support and resistance, or they look for patterns for pattern's sake, and they're fooled by randomness. The algorithm is not random. So I teach you to look at a range and define it in the scope of premium to discount. Equilibrium is here, and if we're bearish, we need the price to get to equilibrium or preferably higher than to go short. In this shaded area here, why did it not just simply trade back to that low and go lower? Why didn't it do that? Think. That's our last up close candle right before the energetic move lower. Inside the context that this is likely a fair value gap that is going to stay open. Why? Because it had no ability to get up into it, close it at all. So that changes the fair value gap to what? A breakaway gap. Breakaway gaps remain open until lower level objectives are fulfilled and delivered and booked. In other words, it goes lower to a specific price level in the discount. Then at a later time, it might come back up to here, but it could be an undetermined amount of time. I don't know when they'll come back to fill in a breakaway gap. And if it's bullish market, everything I just said, just reverse it. This last up close candle prior to the move lower and taking out that dealing range low, that is my ICT bearish order block. It trades lower, comes back up, doesn't really quite get back to that old low, sells off again, then it comes back, ramrods this low here, goes above it, and then consolidates. So anyone that would have expected this little bit of fluctuation through, this would have wore them out. These are days. These are days of trading, S&P. Shorts are going to be scared. It's probably going to go higher. Why? Because they see a bull flag. Run up, consolidation, and they expect it to go higher.